So I lost then, but I'm making up for it now. Okay, so big negative aggregate demand shock. So let's look at this just the way we did before. In this case, again, we'll start the economy at general equilibrium. Now, as you've learned in your problem set, I hope, just because I'm starting all these examples in general equilibrium does not mean that the economy is actually in general equilibrium when we begin a problem or an analysis. It just happens we don't want to have multiple things going on. And if that's not what you saw in your problem set, I'm sorry. Okay. Now, you might ask yourself, well, why would the central bank do what they did? Well, one of the reasons is this inflation rate of pi naught that they were looking at was 13%. So it was very, very high. People, and central bankers in particular, do not like high rates of inflation. So part of the reason that the central bank, Federal Reserve, increased interest rates so much was they wanted to bring inflation down. They knew exactly what was going to happen in the economy. Well, not exactly, but we've got a model that's going to tell us what will happen, right? So we have this large negative aggregate demand shock. Boom. Aggregate demand curve shifts far to the left. Notice before inflation declines, businesses are perfectly comfortable producing at point A. But this sharply higher real interest rate meant that it was very expensive to borrow money. Very few people borrowed money. You had to be really crazy like me to borrow money in those days. Quite expensive. So if you don't borrow money, planned expenditures go down, aggregate demand falls. So aggregate demand is sitting way back here, this red dot, where supply is at point A. So now we've got a lot of excess supply in the economy. We're producing too much relative to what we're selling. Inventories are building. This is not a good thing from a business perspective, right? Because this means you're producing things, incurring costs, but you're not selling things, so you have no revenue to offset that with. So two things generally happen. One is you reduce production. And as you reduce production, you're still trying to get rid of your unplanned inventory build, right? But that excess supply, one way to do that is cut prices. So now, all of a sudden, what you're seeing is prices are now beginning to fall, or inflation is now beginning to fall. So businesses, though, are still expecting inflation to be pi naught. That's the cost side of their expectations. But what they actually see, their selling price is rising slower. So now they see their profit margins being squeezed. So the level at which they're comfortable producing at is also declining, a movement along the short-run aggregate supply curve. At the same time, as inflation is falling, the central bank is allowing the real interest rate to come down along the monetary policy curve. Borrowing picks up, planned expenditures rise, aggregate demand rises, at least from where it was, but still, overall economic output has fallen to Y1, and inflation has fallen to pi 1. Now notice in this aggregate demand shock, nothing has happened to inflation expectations. So our short-run aggregate supply curve is still the same as it was before. There has been no shift. And now we have a short-run equilibrium at point B. It's not general equilibrium. And we've got lower inflation, lower economic output, which also means we have a higher unemployment rate. Then we can ask ourselves, what happens next? And what happens next is based on inflation expectations. So in year one, we expected inflation to be pi naught. It was actually turned out to be lower at pi 1. So the following year, inflation expectations will ratchet down. We now will expect inflation at pi 1. For pi 1 to be an equilibrium inflation rate, a long-run equilibrium, the short-run curve would have to pass through the long-run aggregate supply curve at an inflation rate of pi 1. So the curve is shifted down. Now, before anything else happens, we can now see that at that lower inflation rate of pi 1, aggregate demand is on our aggregate demand curve. This is where people, buyers, want to buy. Consumers, businesses, governments, and foreigners. But businesses want to produce at this inflation rate back here on our long-run aggregate supply curve. So we still have excess supply in the economy. That excess supply in the economy has the same characteristics that it had before. Right? We're building inventories. We don't want them. We're laying off workers. Existing workers can't ask for as big a raise as they did before. So inflation starts to go down. We cut prices to move our unsold inventories. So inflation falls. As it does, businesses will now produce less. But lower inflation also allows the central bank to reduce the real interest rate along the monetary policy curve. A lower real interest rate leads to more borrowing, more planned expenditures. So economic output now begins to move back towards potential. That is, the output gap begins to narrow. And at this point, we might expect the unemployment rate to start to fall. So now we're in a new short-term equilibrium at point C. But once again, it's not long-run equilibrium. So this adjustment process continues. And it will continue until we get to long-run equilibrium, or general equilibrium. The general equilibrium is going to end up where the aggregate demand curve intersects the long-run aggregate supply curve. Again, this could take several more years, or time periods, for this to happen. But eventually, expected inflation will end up equaling actual inflation. So we'll be at a permanently lower inflation rate. Economic output will have gone back to potential. The output gap will have been eliminated. And unemployment will be back at the natural rate of unemployment. So permanently lower inflation, no long-run change in the output gap or in the unemployment rate. Again, how big the initial drop is in inflation, or how big the ultimate drop is in inflation, depends only on the size of the aggregate demand shock. It does not depend upon the steepness or flatness of the short-run aggregate supply curve. The steepness or flatness of the short-run aggregate supply curve will tell us, however, how quickly we get back to that new general equilibrium position. The steeper the curve, the more flexible our wages and prices, the faster the adjustment process is. The flatter the curve, the stickier our wages and prices, the slower the adjustment process that takes place. Notice the entire adjustment after the initial shock, which was caused by the demand curve. All of the adjustment takes place because the short-run aggregate supply curve is shifting. The short-run curve. That's the adjustment mechanism in this model. And that adjustment mechanism is coming about because inflation expectations are changing. And if we look for the pattern in this adjustment, what we see is, again, a counterclockwise move from point A to point N, or basically from 12 o'clock to 6 o'clock. If you operate an economy below potential output, inflation will be decelerating. We will have disinflation. And if we look at the data, we can see exactly what happened. The unemployment rate rose from roughly 7.5% to 10.5%, and at the same time, the inflation rate came down a lot, from just under, around 12% down to about 2.5%. So if you see that big a change in inflation, 10 percentage points, probably tells you had a really, really negative output gap. Right? It came down a lot in a relatively short period of time. Remember, this is January 1981, this is January 1983, so we're only talking 24 months. So we're talking very, very rapid changes there. And here's the annual data. You can see that the unemployment rate rose quite sharply, and inflation came down. In fact, the unemployment rate then peaked and came down some more. Notice also, not that these were general equilibrium levels, but we ended up at basically the same unemployment rate that we had before, which means the output gap would be basically the same as we had before. So once again, what we see is negative output gaps generally are associated with declining inflation, disinflationary period. Positive output gaps are generally associated with rising inflation periods. Okay, now here's a second negative demand shock taking place in the early 2000s. I'm not going to go through the shock itself in any detail, but I just wanted to show you some of the other factors that could have led to or can lead to a negative shock. So in the early 2000s, we had a stock market crash. Right? So wealth would disappear, autonomous consumption would decline. Consumer confidence also declined. Again, that's another decline in autonomous consumption. Businesses became much more pessimistic, or business executives became much more pessimistic, so autonomous investment declined. So notice that all three of these are telling us that autonomous expenditures are declining. The fourth thing that happened is that interest rates on corporate bonds, so remember, corporate bonds are what businesses issue in order to raise money. So we can think about this as the interest rate that businesses have to borrow at. So we represent that with financial frictions, and in this case, financial frictions went up. So again, all four of these items would then cause the aggregate demand curve to shift to the left. Again, another negative aggregate demand shock, assuming that we started in general equilibrium, we'd have a negative output gap. Having a negative output gap would bring inflation down. So here's the data. So if we look at what happens during that period of time, we can see unemployment goes up, and inflation, depending upon which inflation measure you want to use, inflation comes down. Also notice that not only did unemployment rate go up, but it stayed up for a very long period of time. So indicating that we had a negative output gap that was not quickly being reduced. So inflation, especially core inflation, the purple line, continues to decelerate from 2 3/4% to about 1%. Again, negative output gaps lead to disinflation. Positive output gaps lead to accelerating inflation. And there's the data. Now, one of the things that we'll have to take a look at in a couple of weeks is what kind of macroeconomic policy, whether it's monetary policy or fiscal policy, should be used depending upon the kind of shock that the economy experiences. So what we've looked at is aggregate demand shocks, and you might be able to figure out on your own exactly what kind of monetary and fiscal policies we should use. The reason you should be able to figure that out is that we know that both monetary and fiscal policy affect monetary policy, the MP curve, fiscal policy, the IS curve, and both of those affect the aggregate demand curve. So government policies also affect the aggregate demand curve. But let's think now about aggregate supply shocks. So there are really two kinds of aggregate supply shocks. Those that affect the short-run curve, which are sometimes referred to as temporary aggregate supply shocks, and those that affect the long-run aggregate supply curve, which are referred to as permanent aggregate supply shocks. Now, when we have this tendency to use positive and negative with respect to aggregate supply shocks, just as we did with aggregate demand shocks. But when we talk about the supply side, we actually want to think about what's happening to inflation, not what's happening to economic output. So remember, demand shocks, we want to think about what's happening to economic output. Supply shocks, what's going to happen to inflation. So a positive shock, I know this sounds backwards, but a positive shock leads to lower inflation. A negative shock leads to higher inflation. Right? Higher inflation is the bad, the negative. Lower inflation is the good or the positive. So we don't want to think about which way the curve is shifting. We want to know what is happening to inflation. So let's think about temporary shocks. So a temporary shock, a positive shock, is going to cause the short-run aggregate supply curve to shift down, lower inflation. A negative shock causes it to shift up. So here's the classic example of a negative supply shock. 1973. OPEC quintupled the price of oil. In the context of our model, that is a price shock, right? Our rho term sitting at the end of our short-run aggregate supply equation. There were also significant droughts that led to crop failures that caused food prices to soar, and that also led to much higher food prices. We treat that, again, as a price shock. Rho term goes up. And finally, the government had been imposing wage and price controls. That is, in part because inflation was high, the government issued rules and regulations that said, you can't raise your prices more than this, or we'll send you to jail. So most people said, I don't want to go to jail, so we'll hold prices down. Now, we all know from microeconomics that if you put on a price ceiling that is below the market clearing price, you will have excess demand. And when the price ceiling is lifted, prices are likely to shoot up to that equilibrium level. And that's exactly what happened here. Once the government got out of the business of controlling wages and prices, we ended up with sharp increases in both as markets tried to find their equilibrium levels. In the context of this model, we would still treat this simply as a price shock. So we've got three price shocks all occurring in a very short time period. Temporary, negative supply shocks. Now, one thing about price shocks. We call them price shocks, not inflation shocks. We call them price shocks because what we're talking about is the price goes up, it stays at that higher level, but it doesn't continue to rise, except at the general rate of inflation. Right? So oil prices go from $50 a barrel to $100 a barrel in a short time period, but then they basically stay at $100 a barrel. Right? That's what we mean by a price shock. So the price is going up, stays at that higher level, but doesn't continue to double or triple or whatever it is in subsequent years. If it did do that, we would have to follow on with additional price shocks in our analysis. So let's not do that, at least not yet. A couple of Tuesdays from now might be a good time. Oh, did I say that aloud? So let's suppose that we're at point A, general equilibrium, and all of these events happen. So our price shock term is in the short-run aggregate supply curve, so the curve is going to shift sharply higher. So we now have a new short-run aggregate supply curve in year one, but in the context that we're doing this in with adaptive inflationary expectations, expected inflation has not changed. So then we can again come back to where are we now after the shock, but before anything is adjusted. So when we sit here at pi naught, what we see is that demand is sitting out here at point A on our aggregate demand curve. But businesses only want to produce way back here on our short-run aggregate supply curve. Why do they want to produce a lot less? Well, think about what's happened. Right? They're only expecting inflation of pi naught. So if you think about what they are expecting, and now what's happened is input costs have gone way up. Right? Energy is more expensive, food is more expensive, wages are more expensive. Their profit margins have been crushed by this. Businesses now all of a sudden say, whoa, at that narrow profit margin, I don't want to produce as much. So supply would fall at this inflation rate. Notice what we have, excess demand in the economy. So when there's excess demand in the economy, we're going to get higher inflation. Now remember, some of the higher inflation is coming directly from the price shocks. So we can't get away from having to pay for more expensive gasoline, more expensive groceries. So inflation takes off. And what happens then when inflation moves up? The central bank will raise the real interest rate along the monetary policy curve, which reduces planned expenditures and aggregate demand along the AB curve. But as inflation rises, businesses are expecting inflation of pi naught. That's their input cost. But now they see a higher selling cost, so they're willing to produce a bit more. We get back to equilibrium at point B. When we're there, economic output has fallen, and inflation has risen. So inflation rises mostly because of the negative temporary supply shock. It's the shock that causes inflation to go up. Demand actually decreases because higher inflation leads to higher real interest rates and less borrowing. And we find ourselves in a short-term equilibrium at point B. Now what happens next? What happens in year two? Well, remember, the entire adjustment process is always because inflation expectations are changing. So in year one, we expected inflation of pi naught. It was actually pi 1, higher. So now inflation expectations have to move up to pi 1. That will cause a shift in the short-run aggregate supply curve. But here's what's interesting about supply shocks. It's an upward adjustment of expected inflation. But the short-run aggregate supply curve actually shifts down relative to where it was in the prior year. That's because the price shock occurred. Another way of thinking about this, it has shifted up relative to our original short-run aggregate supply curve. That's upward movement is the change in expected inflation. The downward movement from our post-shock short-run aggregate supply curve is because the shock happened in year one, but it doesn't happen again in year two. So there's no additional push on inflation from